Welcome to the IFRS for SMEs technical series. I am Calverwell and I help SMEs apply accounting standards to improve reporting, strengthen compliance, and build credibility with banks, investors, and partners. In this video, part of the Technical Accounting for SMEs series, we are looking at Section 4, the Statement of Financial Position. We'll cover the purpose of this statement, its minimum content, the classification of items, and key disclosure requirements. The Statement of Financial Position, sometimes called the balance sheet, presents an entity's assets, liabilities, and equity as of a specific reporting date. It is the snapshot of the financial health, showing resources controlled and obligations owed. Importantly, recognition and measurement of items follow other IFRS for SMEs sections. So not every item that meets the definition of an asset or liability will appear on the statement if recognition criteria are not satisfied. As a minimum, the statement must include cash and cash equivalents, trade and other receivables, financial assets not included elsewhere, inventories, property, plant and equipment, investment property, both at cost and at fair value, intangible assets, biological assets at cost and at fair value, investments in associates and joint ventures, trade and other payables, financial liabilities, current and deferred tax balances, provisions, non-controlling interest, and equity attributable to owners of the parent. Additional line items, headings, and subtotals are required if relevant to understanding the entity's financial position. Items are classified as current or non-current, except when a liquidity-based presentation is more relevant. Current assets are those realized in the normal operating cycle, held for trading, realized within 12 months, or cash unless restricted. All others are non-current. Current liabilities are those settled in the operating cycle, held for trading, due within 12 months, or without any unconditional right to defer settlement. All others are non-current. The standard does not prescribe a strict sequence or format. Instead, entities must ensure that line items are separately presented when material, aggregated when immaterial, and sequenced in a way that reflects nature and function. Materiality, liquidity, and function are all factors in deciding presentation. Disclosures may be in the statement or notes and include sub-classification of PPE, receivables, inventory, payables, and provisions. Equity classes such as share capital, reserves, and retained earnings. Entities with share capital must also disclose authorized, issued, and paid up share numbers, par value or no par, reconciliation of shares outstanding, rights, preferences, and restrictions, treasury shares, and reserved shares for options or contracts. Entities without share capital, like partnerships or trusts, must disclose equivalent information about equity categories and restrictions. Finally, if there is a binding agreement to dispose of assets or a group of assets, the entity must disclose the description, facts, and carrying amounts. Section 4 provides SMEs with structure and discipline in presenting their financial position. It ensures comparability, clarity for users, and transparency in how resources and obligations are presented. Stay tuned for the next part of the Technical Accounting for SMEs series, where we'll explore the property, plant, and equipment section of the standard.